So we have Professor Luis Viceira. So Luis is the George E. Bates Professor at the Harvard Business School. His research focuses on investment management and capital markets, in particular, optimal portfolio choice for long-term investors, the impact of monetary policy on bond and equity market risk, and the disruptive power of fintech in the asset management industry. So Luis is also the author of what I sometimes call like the Bible in household finance, his book with John Campbell, Strategic Asset Allocation, that we all have seen and dwell in quite a bit. He's a governor of the Financial Industry Regulatory Authority, FINRA, among other kind of professional engagement. So he's going to talk about building portfolio for long horizon investors. Luis, the floor is yours. Please share your presentation. Thanks.
Thank you, Paolo. Let me share my my presentation, and hopefully it's now working. It's a pleasure to be with all of you in online format. I wish I would be there, and I guess the rest of us would love to be in that wonderful city, one of my preferred cities in Europe. That was the plan, and unfortunately COVID prevented that from happening. But we have Zoom, and we can be together today to discuss some of the topics on my conversation. So instead of in Stockholm, I'm in my office right now. I'm on that building that you are seeing. Not a bad place to be, but I wish it would be in Stockholm. So let me start with my presentation today by noting, some of the things that maybe building on some of the things that Olivia has been talking about in her first presentation, which is, there is 4 sets of secular interrelated forces, which I think have had a huge impact on retirement systems and a transformation of retirement systems. One is this secular decline in interest rates, which is not only on nominal interest rates, but also on real interest rates. So this is very important. It's not just about inflation, it's about the real side of economic systems. And a second secular force is globalization, both on the financial side, financial leveragation, but also on the competitive side. And that's brought a lot of competitive pressure that also has had a huge impact, I think, on retirement systems. And the fourth force is technological innovation that, has had also a big impact. Robo-advisors, I'm thinking about technological innovation and think about technology side of things in IT, if you wish, but also financial innovation. ETFs or something unthinkable, many, mortgage-backed securities. There's a ton of financial innovation that's been happening over the 20, 30 years. And all of that has also had effects on retirement systems and it's generally how people save and invest. The decline in interest rates and globalization, I think, are the 2 maybe macro secular forces that are behind the end of the prevalence of defined benefit plans for retirement income provision. Defined contribution plans have become the main vehicle to build retirement wealth in the most advanced economies, including the US, including Sweden, and other, we know that the defined benefit plans, as Olivia just pointed out, are in a very bad funding situation in those countries that rely mostly on them. So what's the implication of moving from defined benefit plans to defined contribution plans? It's an enormous funding and risk transfer from institutions to households. In a DC plan, basically households are left to decide how much to save for retirement and how to invest those savings. While in a DC plan, in a defined benefit plan, these are professionally managed systems, professionally managed pool of assets, professionally managed, distribution systems. And basically households only had to think about what pension am I gonna get. Very different, as we all know, for defined contribution plans. So let me, So that's an illustration what's happening in the US. In 1995, DC plans were about 43%. And that had already, after 15 years of heavy promotion of DC plans, they were only 43% of total retirement assets. DB plans were 50%. Last year, the end of last year, DC plans represented already 62% of retirement assets. DB plan only 31%. And as we know, all these plans are frozen. There's no new creation of plans. Those who are still accumulating benefits is only for current employees, but new employees don't get access to them. And forget about Microsoft or Google or any of the new companies to ever offer a DB plan. So DC plan is the way we're going in the US, and Sweden has gone that way a long time ago. And if we think about household wealth in the United States, these DC plans already represent about 41% of total wealth for households in the US. Their house represents about 23%. That's the accumulated, the aggregate balance sheet for households, and traditional pension funds only 21% of assets. All right. So how are households equipped to deal with this huge transformation? I think we have very deep insights from behavioral finance that they are very poorly equipped to handle those decisions on their own. There are all kinds of inherent psychological biases. We're probably going to hear from one of the speakers talk about that. Anna Maria probably is going to talk about poor financial literacy, that they are not equipped to think about how to best invest for retirement. And there is also lack of time. They need to work, they need to take care of their kids, they need to play golf on weekends if they want to. The last thing they want to do is to think about investment. And and there is also lack of interest. People will spend weeks and weeks deciding which smartphone they're going to buy, and zero time thinking about what fund should I be investing. And as a result of all of that, we know that they make many first-order investing mistakes. It's not just minor. We have low contribution rates, as Oli was pointing out, too much redemption whenever they can. That we just heard what's going on with COVID. Lots of inertia, in other words, very little rebalancing. And when there is rebalancing, usually in the wrong way, because they try to time the market. And very poor portfolio diversification, or very naive portfolio diversification. You think if I have 10 funds, I'll put 10% of each of my retirement assets in each one of them, regardless of what the composition of the funds is, which is, we know a first-order investing mistake. And yet, the problem is most are not wealthy enough to afford wealth advisors. They are on their own. This is an example of how investors are performing. This is a study put together by Dalbar back in 2015, where they were looking at basically how the S&P 500 had been doing, how the bond market had been doing, and how was the average investor in any of these funds had been doing. Just to illustrate, what this table is about. In the 10-year period ending in 2015, the S&P 500 had delivered a return of 7.3% per annum. For the average investor in any of these S&P 500 or equity funds, the average return had been about 4%. Huge gap, especially you think about compounding this over 30 or 35 years. That means about basically a difference of could be as high as 60 or 70% difference in accumulated assets over that period of time. Why that? They are redeeming, they are timing the market at the wrong time, all their fees. So all of that accumulated leads you to a 300 basis points of investment performance difference, which is enormous, especially when we think about the typical retirement horizon. So behavioral finance also have made a lot of progress, not in pointing out how households make mistakes and why they make them, but also pointing out at policy issues that can help households overcome their investment mistakes and their behavioral bias. One of the very important idea deserving of a Nobel Prize, as we all know, in Stockholm is nudging Another important idea is the importance of default options for saving rates and for investment, for contributions and for investing options. Third important idea is to limit choice and just give people a set of things rather than giving them the whole world. And not limit, and not being too paternalistic, just give them unlimited choice, but give them access to the candy shelf, but force them to need to opt in. So they need to jump a series of bureaucratic loops in order to get in there. And also, of course, the importance of autopilot, automatic rebalancing, automatic contributions. All of that helps people a lot to save without having to worry too much about the decisions they need to make. And I'm also going to argue that research in asset allocation has also, and portfolio management has also given important insights in the design of portfolios for long horizon investors saving for the university of the college of their kids, for their own retirement, for buying a house. How do we think about investing at a long horizon? So we have the research in behavioral finance, and which some of my colleagues will talk about today, and I'm going to talk a little bit about the research in asset allocation and portfolio management at long horizons. Also, the fourth is the technological progress, and also to combine with regulatory oversight, they have helped actually implement solutions to many of these mistakes. We might have in many of the system-based indices plans now automatic contributions. We have very careful choice of defaults, and just with a proper investment default. And two of the main things are evolving for that are target date funds and the products that are being offered in the open market by robo-advisors. Both of them, target date funds are being used mostly in DC plans, but also in the open market, and the products are being offered by robo-advisors. They are solving two big issues. They solve the issue of automatic rebalancing, and they solve the issue of diversification. Typically, robo-advisors will be target an asset allocation that is risk-based, and target date funds actually are slightly different because they are targeting an asset allocation which is based on the age or the horizon, investment horizon of the investor. Why having this age or horizon-based target allocation? Well, research to which I have done some contributions, V-Body and Bob Merton also have made important contributions to this way of thinking, and all this research on life cycle investing has shown that basically this horizon-based or age-based asset allocation is approximately optimal, to a first-order approximation for a typical individual with a stable job. Why age-based investing makes sense? Well, the main argument to think about that is human capital. Human capital is a big asset that we all have at the typical person, the typical household with working parents have on their balance sheet. One of the main assets is not the main asset that they have when they are young is their human capital. They have their house maybe that they just bought with a liability side, which is the mortgage typically. Then they have a little bit of savings when they are young, 25, 30 years, 35 years old. And the main asset is the present value of their future earnings, which is what we call human capital. So if they have safe jobs and they're going to stay unemployed only for a few months, moving from one job to the next one, it's fair to say that if you think about the whole asset side of the financial, of the balance sheet, small slice of that pie is financial wealth. Another slice is the house. But the main one is human capital, and that looks like a fixed income investment. For safe jobs, that's the way to think about your human capital. Of course, you cannot sell it, and for good reasons, of course. But it's equivalent to having a big chunk of fixed income in your balance sheet. As you age, your future earnings decline. You're not going to have you become wiser. Your human capital in that sense become much better, but your capacity for future earnings declines dramatically. And by the end of your, when you're close to retirement, that human capital in terms of present value of expected of earnings potential is actually very small. Relative, hopefully you have grown your financial wealth, now you own your house free of a mortgage, and the main side of the pie is financial wealth, where your human capital is a smaller size of the pie. And that means, you know, your implicit investment in fixed income that represented in your balance sheet by human capital is now much smaller. So for young people, if they have a ton of fixed income, why would they make their DC contributions all in fixed income? Why would they make, you know, their contribution to a robo-advisor all in fixed income? They have a lot more capacity to absorb risk and to invest in equities. As they go closer to retirement, they need to compensate the loss in human capital in this fixed income implicit investment with more investment in human capital. As a result, you get, you know, when young, you have a lot of more capacity to absorb risk, invest a lot more in equities and risky assets more generally. As you grow age and grow older, start moving some rebalance towards, you know, more and more fixed income. And that's essentially what target date funds do. And the rationale for that I described actually in my own market paper many years ago. So, but you know, so these target date funds actually do, I think, a good job. Of course, you would like them to be customized to the risk, human capital risk of every investor. Technology doesn't allow us to do that just now, but I think we'll do it with time. But to a first order approximation, they're capturing diversification, automatic rebalancing, and age-based investing, and they are doing a good job. Now, there is still room for improvement in these automatic rebalancing schemes, both in the open market and in DC plans. And I wonder if some of the shortcomings seem to be reproducing investor biases or catering to them, which is you know, an equivalent way of thinking about that. And I'm just gonna focus on the time I have maybe on to think about the fixed income allocation and the composition of this fixed income allocation, right? So what do we know from research in long-term allocation? That the fixed income allocation in a robo-advisor product or in a target date fund should look like? Well, research in long-term asset allocation has, you know, argued that the safe asset for a long horizon investor is actually an inflation index bond whose coupons and maturity match the spending needs of the investor over their investment horizon. It's not a cash instrument. It's not about investing in short-term CDs or short-term treasury bills or even short-term inflation index bond, let's say 1 year out, 5 year, and then rolling them over. No, it's more about a coupon bond, which is indexed to inflation and match the maturity of the horizon of the investment or retirement of the investor. Why? First of all, why real? Well, you want to protect investors from their spending from the impact of inflation. Why matching the maturity? Well, it protects investors from the payoff uncertainty that would be coming from a strategy of rolling over short-term cash instruments. And of course, a long-term bond protects investors from declining interest rates by compensating them with capital gains. And a strategy of rolling short-term instruments doesn't do most of this, certainly not protecting investors from declining interest rates. Is that important? Here is an example. So this is the yield curve in the Treasury yield curve in the United States in January 3rd, 1995, January 2nd, 2003, July 30th, 2019, just about a year ago, and just about a month ago, July 28th, 2020. So say Uncle Bob in 1995 put a $1 million in 30-year treasury bonds, right? He would guarantee himself for the next 30 years, and he would still have 5 more years in his still, an annual income at interest rates in 1995 of $80,000. And today he would be getting from those 30-year bonds, $30,000 of annual income, plus the principal that will come in 5 years, then they can give to his nephews or nieces. What if he invested only, he decided, okay, I'm just gonna do what my advisor tells me, 1 year treasury bills. At that point, because the yield curve was relatively flat from 1 year on, you know, he could buy himself about $72,000 of annual income, but just for 1 year. He was rolling that in 2003 that rolling strategy would only buy him 15,000 of annual income. While, by the way, if he had invested in the 30-year bond, he would still getting 80,000. And just a month ago, his 1-year treasury bill would be paying him 1,000. While, by the way, if he had invested in the 30-year treasury bond portfolio, they would still be paying him 80,000 bucks. And by the way, both of them will be keeping the $1 million bucks intact. And you would say, oh, this is huge decline. It's all about declines in inflation. Not quite. You know, tips came out in the United States in 2003. So let's think about Bob, Uncle Bob buying a 30-year treasury in tips. They didn't exist about 10 years, but look at the yield curve. It was more or less flattening there. If anything, was upward sloping. Think about Uncle Bob could buy 1 million of 20,000 of annual real income in 03, growing with inflation, and his 1 million growing with inflation, and 18,000 of real income for 5 years in 03. Today, the rolling 5-year strategy would be buying about minus 11,000, while, you know, his annual inflation index bond would still be paying him 20,000 plus inflation every year. So it's not about inflation, it's about real rates too. Huge decline. Imagine if Bob was planning to live on retirement, now he owes 11,000 bucks. Or if he was in nominal, he still have 1,000 to fund his annual spending out of that 1 million bucks. So huge changes, and that suggests go long when you have a long investment horizon on the yield curve. What do target date funds do? This is research from Van Velsen, Bollenars, and Bovenberg in a recent paper in the Review of Finance. They look at the duration of fixed income portfolios in target date funds. The weighted mean by assets is about 7 years. The 90th quartile is about 8. I'm sorry, I just not even getting the numbers right. 6 and 7, by the way, 7 the max, you know, and the bottom quartile about slightly below 5 years. For people, you know, if we look at people 25, 30 years old, at most 13 years, median is about, weighted mean is about 7.5 years. When these people arguably have at least 30 years to retirement. So 5 year, that's this one here, right? Not very good. Now, why are these managers targeting such low duration? And I think they're targeting it because, you know, we have this implicit investor bias, this thing about market timing, you know, the argument you hear, oh, interest rate can go lower. And by the way, I've been hearing that in serving in investment committees for the best part of the last 30 years in every meeting since 2000 or early 2000, interest rates can go lower. They're gonna go higher, they haven't. Or funding income is extremely expensive, you know. But it's, you know, there are these biases that I think constrain people from doing that. And it leads to, you know, very low duration in these funds, which is not, you know, I would argue appropriate for these target date funds. Also, long duration is a great thing to have, has been a great thing to have over the last 25 years because of the switch in the stock bond correlation. Correlations have been mostly negative over the last 20 years. And that means bonds are an amazing hedge for declines in equities because of this, you know, average 40–50% negative correlation in stocks and bonds. And by the way, this goes all the way to the most, you know, to last month. So the stock bond correlation remains negative and strongly negative in the markets. Another room for improvements in the equity allocations. This is the typical glide path of the, this is the Vanguard glide path, which is actually one of the most sophisticatedly designed target date funds. So, you know, the blue part is US stocks. The mustard yellow part is international stocks. And as you can see, even though the US stock market represents 50% of the global markets, the investment in global markets is, you know, the US clearly at young age, think about 25, 30 years on the left side of the graph, you know, that thing is taking over, you know, way more than 50, 60% of the portfolio. Moreover, as the investor age, they move them out of equities, as we discussed, you know, the bond allocation starts going up, but guess what? Proportionally, the proportion of global equities over US equities declines too. So they move them more and more into US equities. You know, why? Well, I think, you know, this is again catering to investors, maybe mistakes, maybe catering to, you know, the professional investor own biases. Is the whole thing about home bias. You know, what is home bias? Well, what does it imply? It implies that a bet really that your local market, you know, you're a Swedish investor, you know, and you are a home bias. You're the proverbial Belgian dentist and you invest only in Belgian stocks. You're just making a bet that the Belgian stock market is going to do better than the rest of the world markets in the long run, which is, you know, it doesn't stand to any reason. And, you know, calling you know, those bets right is very hard. You know, people think I can go from Belgium to Sweden and then go to emerging markets and go to US and then to Argentina. I'm going to do well. I think we have plenty of evidence that's not correct. I mean, you just give you an introspective example. These are the two markets the two best performing markets in the 1970s. One was Japan with a return of almost 400% over 10 years. The other one is the US with a return of about 77%, or about 6% per annum over 10-year period. Most people will think, oh, well, Japan went up 400%. Obviously, over the next decade, let's make the forecast which market is going to do better over the next 10 years. Surely the US must do better than the Japanese market, given how, in comparative terms, how poorly the US did relative to Japan. What happened over the next 10 years? Japan did a return of 1,143%, and the US a return which is not shabby, 400%, but not quite 1,143%. Now, what would you be calling the shots in '89? You need to warn them. And how would you be calling the shots in, I guess, August 24th of 2020? Right, so this is just to give you, it's very hard to pick winners, not just a 1 year, not even 10 years. People think over 10 years is much easier to pick winners. It's not easy. So what's the answer to that? And that's an example. Here is for the S&P 500, the Japanese index is dark blue. Again, the light, the green one is the other world developed markets, and the pink one is emerging markets. And over the last 50 years, how well they have been doing each one of them. As you can see, the color tiles move up. What's on the top changes from decade to decade. I would love to hear what you think is going to be, and then we can make a bet to see which tile is going to be on top and which tile is going to be on the bottom by the end of that. So you don't know the tile, and I don't know the tile, and most people saving for retirement don't know the tile. Why play with their money? Why not giving them a geographically diversified portfolio? It seems to me a geographically diversified portfolio is just a bet that the world is going to be better in 10 years from now. Which, it doesn't happen, but, it's a safer bet than to say Chile is going to be a better bet than the US, or, Korea is going to be a better bet than India. I just don't know. I think it's much better to make a bet on the world than make a bet on specific geographies. Also, people argue, well, it doesn't pay so much to be globally diversified because global correlations have increased. These are global bonds correlations, stock correlations in the period 86-2016, and then split in two equal periods, 86 to 99, 2000 2016. And you can see, both bonds and stocks, they have experienced a huge increase as a result of financial globalization. And trade globalization, huge increase in their correlations. Bonds for 44% average stock bond correlation across markets in developed countries, 64% in the last 10 years or so. That hasn't changed much. Stocks, 54% up to 1999. In the last 20 years or so, 70%. Big increases in correlation that, of course, that's an argument that has been made, and to argue that there is less benefits of global diversification. And, you know, just in green, as you can see, the stock bond correlation is the negative stock bond correlation, not just a phenomenon in the US, it's a phenomenon, worldwide phenomenon in developed markets, from about 13% correlation before 2000 to about minus 23% average stock bond correlation in global markets in the last 20 years. And, you know, that's just a plot to see how these correlations have moved over time. But, you know, I have a recent research where I'm basically showing that the correlation actually has increased at short horizon, but not at long horizons. And the reason is because the main source of this increased correlation is actually investor sentiment. The fundamentals actually have not increased that much. And what determines long horizon correlations is not the investor sentiment, which is transient and impact short-term correlations, but not so much long-term correlations are determined by fundamentals. And the correlation of fundamentals, and I don't have time to show you a bunch of plots, that correlation has not increased that much. So that means at long horizons, correlations are still as low as they used to be. And of course, there's as much you know, room for global diversification as they used to be 20 or 30 years ago. And, you know, other things where there's room for improvement is alternative risk premia. We have a lot of research. We know risk premia, alternative risk premia hasn't done that well in the last couple of 3 or 4 years. But, you know, there is a lack of integration of alternative risk premia in these products. Some robo-advisors have been in trying to incorporate some of that in their products, like Wealthfront in the United States. But, you know, there is still a lot of room to do on how to properly integrate these. You know, you could argue long horizon investors probably could take a value tilt in their portfolios, a quality tilt. We don't tend to see much on that. Too much emphasis, though, on alpha, and alpha is a very flimsy thing, as we know. And also, these products are either risk-based or horizon-based, but they are not both. And, you know, this is just the impact of low vol in the Vanguard glide path that I just showed you, what it would imply over 30 years on some simulations. It basically cuts the left tile quite a bit in terms of, you know, how much wealth you're gonna accumulate. And also, you know, it doesn't have and also even increase the mean allocation. So other things, you know, that are basically a function of technology, but we are getting there, you know, is lack of customization. Target date funds and robo-advisor products would not be possible without all the growth in IT, all the trust that we now put in things like, you know, websites and things like that. And of course, the development of ETFs and other type of products that allow, you know, these funds to do all this rebalancing for their clients. Technology is not yet there in terms of allowing more customization, but I think we're getting there. Some of the products like Wealthfront in the US does tax optimization for the clients with larger accounts. They can now do that in an automatized way. And but you know, there is also a lot of a lack of integration between retirement and non-retirement accounts. There's too much partition. That's related to these biases of mental accounting. We need to think about in an integral way of the balance sheet of the household, and we don't do that. Tax inefficiencies. You know, some robo-advisors are incorporating that thing, but you know, if we were thinking about retirement and non-retirement accounts, and we think about retirement accounts as a tax-exempt account, we would think about asset location in addition to asset allocation. And you know, we don't have any products there that think that in an automatic way, and those are like, you know, low-hanging fruit, if you wish, right? And of course, there's a total lack of integration between spending plans and needs in most of these products. Some robo-advisors are trying to fix that. They're thinking more and talking and trying to get households to tell them more about their spending plans and think about portfolios that are trying to match the spending plans of these households. So let me stop here. It has a lot of progress to help investors save for the long run. I think the products out there are an order of magnitude better than we had 20 years ago, but there's still plenty of low-hanging fruit to improve the design of portfolios. And I have been trying to give some kind of the most, things that could be done today and for some reason not being done. And I'm just hypothesizing that have to do with either catering to investor biases or the biases of the asset managers managing these products. Thank you very much. Let me stop sharing my my screen.